Hey guys, Freaky Finance here. Last week we looked at DHT tanker play, and this week we're gonna look at a nat gas play in the by the Texas and Louisiana border. Ticker CRK on the New York Stock Exchange, and it's Comstock Resources. This company is fairly small. All operations are along the Texas and Louisiana border. Fairly decent working interest, so 82%. But yeah, their acreage is pretty much in the Haynesville shale area, and that's where they did most of their drilling. And they also have the Bossier. Not crazy amount of operations to try to keep track of. It's really a dry nat gas play in southern United States. One of the things that's nice is because it's very close to the Henry Hub. I mentioned this maybe really quickly when we did the Enbridge video, but Henry Hub is a big deal for nat gas. And basically, for transportation cost wise, the closer you are to delivery points, the better. And this company, one, is close to Henry Hub, and two, is close to Carthage, which is also nice, so it can get to where it needs to go quicker and cheaper. That's how I view it, just from a geographical standpoint. And Henry Hub is nice because it's right on the Gulf for exporting. One of the things before we jump into the numbers is that they bought Covey Park in 2019. I need to bring this up because it's a company that was bigger than themselves, so it's very weird when you see a smaller company buy out a bigger company. But obviously, well, maybe not obviously, but some of you guys might know that Jerry Jones, who we'll talk about in a little bit, pretty much backs this company. He owns more than 70%. And anyway, he helped fund the takeover of Covey Park Energy as well. And we're going to see that when we go through the year-over-year comparisons in production. There's a big jump. So I wanted to point that out. So the reason why I'm looking at it today is this Senate clip on February 26th, late Friday, is this basically 9.5 hours in on the second day of the hearings. We finally hear from a producer of nat gas. So they go through like the generators of electricity, retailers of electricity, because Texas had a huge weather event, right? And so anyway, at this mark, I'm just going to play the clip. I'll try to edit best I can. Hopefully you guys can hear it. I've never usually played a clip from somebody else while I'm doing my own little videos, but I think this one's very important, so hear this out.
The statement, not you're sorry, I believe that, but when you say what you did, how much truth is behind that? How much money is in discussion in a roundabout way?
And I think we provided a kind of a real accounting report from our participation in the spot market for this, really about a 5 to 6 day period. Outside of those particular days, I think the spot prices and the index prices were fairly aligned with each other in that $3 number that you've heard, from live hearings. So I think it's a limited amount of actual production sold there, and then as a large amount of our production was committed to at those other prices. So I think we stated in that report somewhere around 500 million a day, was available to sell in the spot markets, during that period for us.
I'm sorry.
As an agent on behalf of other working interest owners, royalty owners. So that whoever owns the wells that produce those molecules, would have that elevated price for that period of time, and then returning back to the more normal prices, by that weekend.
Right, but and so I'm sorry, just the one value for that during those 5 days, or the compressed time frame.
I think we said in that report that we averaged.
I think you said it, but I just couldn't hear it.
Sure, about somewhere around $55 for the spot sales in Texas,
And with as much as you were able to provide, and we're glad that you were able to provide, but how much does that equate to?
Well, I think we don't really know. What we don't have a full accounting for is the really high transportation costs. We also paid to get the production there. The normal transportation rates, which would be maybe as little as 10 cents, were highly elevated too.
If you just have a number roughly.
I don't have a number that would be very accurate because we don't know.
All right, thank you. Thank you, Mr. Chairman.
Thank you, Senator Campbell. Senator Johnson.
So anyway, what I heard there is basically, if you listen to the full thing, basically they have about 35%, maybe 40% at the specific time of the storm exposure to the spot market, which means they can sell nat gas right on the spot market. And one of the things that was nice about this company is that they were on the Texas-Louisiana border. So when the storm hit Texas, it was slowly moving east, right? So these wells were still functioning very well. So they were able to still produce about their 500 million cubic feet per day to Texas, to the spot market. And they said that they averaged about $55. And if most of you are familiar with nat gas market, you usually see, well, lately it's been approaching 3, let's just say that. But during 2020, it was actually much lower, and 2019 wasn't great either for nat gas. So basically, just remember it went from, let's say, $3 to $55 for these guys for 5 days. And so what that works out, if you do the math real quick, it's basically 500,000 times 55 times 5. So roughly speaking, maybe that's about 120 million, 127 million. I'm just top of my head. And so you're like, okay, they made a decent amount of money. I should have mentioned this before, that working interest is like royalties, so it's not all going to be Comstock. And he did mention that their transportation costs are going to be higher, so it's not like this all feeds to the bottom line, but a lot of it will. So, or at least that's my thinking. And I don't think a lot of people actually listened to this whole hearing. Like, there was 14 hours the day before, 9 hours, and this is at the very end of the 9 hours before Friday. So I feel like, and I didn't see any market activity pick up on this. It was very interesting because this is all public, right? So I was like, oh, this could be an opportunity. So I ended up buying it. So I should have probably led with that for this video, but I do have a position in it. Ultimately, the timing on this is a little bit interesting because it's not like a huge bull of Comstock, right? This is really a play on this Senate speech, honestly. And so what I'm thinking is when Q1 rolls around and this shows up in the earnings, we're going to see a beat, right? And we're going to see how the market reacts to that. Part of it's probably priced in because it did move from, like, say, $5 to $6 during the storm. And actually, it was before the storm. I was anticipating higher prices, right? But I don't think they know that the company made, at least in my mind, at least more than 100 million, right, in 5 days. So that's my angle. I could be completely wrong, and we'll find out soon enough when I do Q1, right, earnings. But that's why I bought in. It doesn't. We'll go through the numbers to see what that means for a company of this size. It's not life altering or anything like that, but it is interesting. I should have also mentioned that this was the CFO of Comstock, and he's the guy who said that statement that he got destroyed for, and he got called up on this statement as well. As basically he said it was like hitting the jackpot during the Texas storm, right? And that was on his earnings call, which was right when the storm was still going on, pretty much. Anyway, he's that guy. So if you're an ESG guy or you're in Texas, maybe you don't want to touch this investment. But basically, he said it was like hitting the jackpot, and so people didn't like that because people died, right, in Texas. So anyway, that was just me doing the 500 million square feet and how that works into BTUs. So 500,000 and then averaged 55 on the spot for 5 days on average for that production. So that's where the number is coming from. Maybe I heard wrong. For all I know, maybe he just did the math wrong, right? But it was literally like, this was February 26th, so the storm ended, February 17th in Texas. So maybe he didn't even have, like he said, his numbers could be wrong as well. So it's always sketchy when you're doing an investment on very little statement, like a 2-minute clip, really. But I thought it was interesting, so I hit the button on it, and we'll see where it goes, right? I might also play with some options going into the earnings. If this company sells off ahead of the earnings, it would be a good opportunity. So I'm looking at that. What else is there? Let's jump into the numbers first, then we'll jump back to their slides. So annual, kind of like what we have with Suncor, though Suncor has a lot more levers to play and a stabler balance sheet. Comstock has the same exposure to commodity prices, but specifically nat gas. So largely a nat gas play, not an oil play. Oil is kind of like the byproduct. So you can see nat gas sales actually increase year over year, and mainly that's a function of production, because as most people who are familiar with the area know, commodity prices were not great in 2020 for nat gas on average. It's starting to come back, right? But not great. So when you see down here, I got the production here, you can see it shoot up, right? From 292 to 450. Again, a part of the reason for the shoot up is because they bought the other company, Covey Park, halfway through 2019. So you're not exactly comparing apples to apples here, but you do want to point out that production shot up. and sales shot up as a result, even though the average price realized was much lower, right? Well, here, the hedged realized nat gas was this, so that might not seem like a lot to you, but that's per unit, right? So they're only making 235 versus 207. That's more than a 15% drop, right? So even though production shot up quite a bit, and we saw that in the sales numbers, that was at a lower price. So 2018 was actually better because spot or commodity prices were actually higher. So it's really a function of the commodity prices you'd expect for any generator of nat gas or producer. One of the things that's very interesting with this company that caught my eye is really this first part. So these first 5 lines are really good. And sales aren't great because commodity price is bad. Got that. Production though, not that much of an increase, right? Even though we know production shot up, there wasn't a huge increase in cost, which was super nice from my point of view from scaling. But they did have gathering and transportation shot up, and that was more in line with the production increase. And then you had operating leases as well, was also shot up, roughly in line. It still scaled a bit, but roughly in line with the production increase. But overall, like you're bringing in 858 million in sales, but your expenses are only less than $250 million, so 246 million. So you're walking away with quite a bit of money, or you should. And this is the weakness that I want to point out, is this right here, the interest expense. And this sucks, and this is part of the reason, it's really, no one wants to touch energy, right? So anyone who invests demands a high rate of return. And this company's small. It's not like a Suncor that literally just raised 700 million at 4.5% that's due in 30 years from now, which is crazy for energy. Anyway, this company spends a lot. Like I just said, these big cost drivers to actually get the gas out of the ground and where it needs to go, right? Only 246 million. Whereas the interest expense that's going to preferred or to normal creditors is 234 million. So you literally have interest expense almost as high as the expense to get it out of the ground. So this is very interesting because I'm like, well, that's the weakness. Why doesn't the major major shareholder just negotiate some type of loan with private equity that wants like a 5% return? But maybe they can't get that. Who knows? But that's the biggest weakness. And that's not necessarily Comstock's fault. It's just no one wants to give them money at a decent rate. And so it hurts the investment because that's the main, honestly, it's the main expense line item. Just look at them all. They're all dwarfed by interest expense. So if this one can come down, then most investors would win. Even the guy who was giving them lower money at, say, lending it to 5% instead of at 10% or whatever they're at right now, or we're at, I should say. They've taken advantage of this as well, which we'll talk about, which makes the investment thesis a little more interesting. So anyway, the company sold off on average relative to what it was worth before by about 250 million. So it's not like it's crazy cheap at $6, right? And you can't really define cheap because they didn't make money in 2020 because COVID prices were so poor for the commodity of nat gas during the year. So it's hard to reference cheap, but basically it's been trading in a range, and it's been in a little bit of a downtrend because the commodity prices have been in a downtrend. So the balance sheet, obviously interest expense is high, which means debt's going to be high. Debt is high. It's about 2 to 1. So for every unit of equity market cap, you're looking at $2 in debt. So this is not a risk-free idea, right? So there's a lot of debt, but that means it's also leveraged if nat gas keeps going up, right? This company will be rewarded over time because of that leverage. But there's also a risk when leverage is that high. There's always a risk of permanent capital loss, right? Never want to bet the farm on one company. So CFO kind of reflects, GMD is up about 30 million, and CFO's up 125 million. 80 million of that is cash settlement noise from derivatives, so it shows up in the CFO. A little bit of noise there. It is CapEx heavy, so it basically, all its cash flow from operations goes back into the business to keep drilling more wells. So it's not like this doesn't pay a dividend or anything like that, right? Maybe it could if it gets its interest expense in line, but I digress. What else is there? Yeah, this one I wanted to flag again is the interest expense, just how high it is, right? It's 27% of sales is your interest. So 27%, or 27 cents on every dollar you make goes to the bank, or the bankers, or the creditors, I guess is the better way to word it. So that's the biggest weakness. I've brought it up enough probably already. Other than that, cash flow per share looks decent, even at a really bad commodity price environment, right? 2020 was not good for nat gas producers. either was 2019. So even though it looks worse here, 2019 was worse than 2018. So it's been a bit of a downtrend in the nat gas space for a while. But the things that I like is that it's interesting once commodity prices start getting higher, like they have been getting lately anyway. It's interesting if they can take care of their higher debt expense, interest expense. And it's also interesting if they can maintain production with lower capex. So right now they're still putting quite a bit into capex. It's actually higher than their depreciation is each year. But what would be interesting is if they could still maintain decent level of production while cutting back capex. But we'll have to see. Right? But so far it looks very capex intensive. And the main thing, and the reason why I'm looking at it and why I own it and why I'm doing the video today, is the company is interesting in the short term with the extra revenue from the higher gas prices during the Texas storm. Here I just want to point out just the average gas realized for the 2 years. So you saw the numbers, but this is just another way to show just how low they were. So you're actually, they averaged without their hedges, they averaged $1.80. Oh, you can't see me on the way. There you go. They averaged $1.80. So not great, but it's also, if you're looking forward, right now we know that nat gas is worth more than $1.80, right? So their hedges might actually hurt them because it's gone up a little bit, but we'll see when we do the Q1, Q2, and stuff like that. But it's gonna be better than what that is. Anyway, where it should be. We shouldn't say it will be. It should be. Another way to look at it, here's more of like a 2018, 2019, 2020. You can see nat gas pretty much falling off a cliff, going from like say 270 up to 320, and then down to 217 by year end 2019. Down to 180 by December 31st, 2020. That's just their average for the year, right? It was actually finished up higher near the end of the year, and higher in 2021 as well. And you can see oil also falling off the similar cliff. Perhaps that's like an inflection point for this company because the commodity prices have already started to come back. It's already starting to look better than 2020 was, especially because the storm for these guys, I think they made a decent amount of money, right? Like I said, about 100 million. And now we have context with that annual statement. We know, well, if they made 100 million, maybe 120 million in 5 days, that's a decent amount, right? This company only generated 860 million all of last year, so they made 16% of the revenue in 5 days, something like that. So, or at least that's what it sounds like they did. And again, I could be totally wrong, but that's what that Senate hearing sounded like to me. So anyway, this is another way to show the weakness of the interest expense. It's right here. This green is the cash interest expense for Comstock. And this is their cost structure of the gas producers. And they basically say our main expense is interest expense, and their actual getting oil or gas out of the ground into market is actually not that bad. So that's very interesting, right? I'm surprised this, like a private equity company, didn't just take this out, right? They can literally just make the company so much better by just pouring money in at a lower rate, and then their actual investment that they pour in increases, right? I'm surprised it's actually sat here like this. So one of the things that the company's been doing, maybe I'll leave with this one first, because of the storm and because they said they got like the jackpot or hit the jackpot or whatever he said, you can see pretty much right after their conference call, they're like, okay, we're gonna raise some money. So initially they're like, we're gonna raise 750 million, and there's a lot of demand, so they're like, okay, we'll raise $1 billion. Right, and 6.75%. So it's not crazy. It's not like amazing debt, right? But for a company this size with this much debt already, it's decent. So, and then again, March 4th, so Thursday. Today is March 6th, 2021. But you can see that all of a sudden people are giving this company money. And 6.75%, well, it really depends what your context is, but you can see what they're planning to do with the extra debt is pay down the existing debt. So, and the existing debt has a higher interest rate, so they're going to be able to save some money here. And they're also, so you can see here, weighted average maturity increases from 5 years to 6.7 years and lowers the annual interest expense by 45 million, so more money for shareholders. They're trying to lower that interest expense component, right, which is the main thing hindering the company. So they're aware of the issue and they're trying to fix it, and I think they're using the Texas storm to do that. And I think all those steps are good. Though ultimately still 6.75%. Like, it would be so nice if they could get that at 5%, right, or something. But that's a dream probably. But you can see just right here, you can see just what they had before as of year end versus what they're planning to have once they get the money. So they're paying down most of their senior notes due 2025, 7.5%, and then they're paying down about half of the 9.75% notes due 2026. And then they're able to stretch out their maturity to 2029 with this extra money they've been able to raise. So very exciting from my point of view, because the biggest weakness was the interest expense. So they're already working to rectify that. And maybe that trend continues at the higher commodity prices, or maybe they even get a better deal once the company puts out their Q1 and investors see the numbers. Then it's like, oh my god, and then they chase it, right? But anyway, that you can see what the new maturity schedule will look like. And then who owns the company? Like I said, maybe there's a discount because Gerald Jones owns 78% of ownership. But it's always for reference, Jerry Jones is the guy who owns the Dallas Cowboys. He's a billionaire. So that's one of the things that I was surprised about as well. If he's a billionaire, why is his company paying such high interest expense, right? Why doesn't he just negotiate something with them? Since he's a major shareholder anyway, loan the money at like 6% or something. But anyway, that's what I would have done. Maybe there's a reason for it that I'm not thinking of on the top of my head. Anyway, the stock has been kind of, ever since the COVID panic where it hit $4.23, it's been kind of bouncing off that. And then it's going as high. Like I'm in around 6. I think I probably like top ticked this or something. But anyway, I'm in around here. We'll see what Q1's like. Who knows? Maybe it sells off before going into earnings and I don't make any money. But I'm probably going to play the earnings closer to the date. Overall, the company, it generally follows the commodity prices. So 2018 was better than 2019, and 2019 was better than 2020. And you can kind of see that in the range of the share price, right? In 2018, you went from 11.50, right, July period, and then consistently down, back up to 9.50, and now it's starting to almost like level off. And I think it's going to start coming up with the commodity prices, right? And we know that Q1's going to be, well, we think Q1 is going to be pretty good for this company, right? They literally told us that they sold 500 million cubic feet a day for 5 days at $55 instead of $2 or $3, right? It should be a good Q1 anyway, and hopefully they can do something, one, with the cash flow, but two, with the momentum at the banks, like get people, if they can lower their interest expense further, it's going to be nice for this company, because that's the biggest hindrance, because they're geographically, they're so close to the hub that their costs are low. So as long as they can lower their interest expense, this company could be a real winner, right? So it's kind of exciting, which you can see nat gas has not been kind in the last few years. And the same thing with, like we talked about Suncor, right? So Suncor is obviously different than this kind of company, where it's literally just a nat gas producer in one little area. And here's the nat gas prices just for reference, just to see kind of. And just for reference, these are dollar per unit, right? So say we're at 270 right now. 55 is off the charts here, right? So for the winter storm event. So, they made some pretty good money. But I don't know how much actually trickles down to us versus, I know some will come to royalties, and they mentioned transportation costs are higher, but I mean at $55. you should get some money. So we'll see what happens. I'd like to know your thoughts on this one. I got quite a few nat gas plays. This is the one in Texas that I'm thinking of playing for the Texas storm. And yeah, have a great rest of your day.